You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Ladies and gentlemen, today's guest is Nelson Lee and Juan Vargas. Nelson has been a real estate investor since 1994. He has 1,000 units as an equity owner in Texas and Arizona. He's a full-time accredited investor with 32 plus years as a president and founder of his commercial landscaping and snow plowing company. And as far as Juan Vargas, he started investing in 2016. He sold a 32-unit complex with a 389% return. How awesome is that? He's also a GP, KP in 1,000 units and a limited partner in 1,050 units. He's a full-time multifamily investor and operator. How you guys doing today?
Doing great. Yeah, thank you. Thank you so much for the opportunity to be on your show, Will.
Yeah, man. I'm glad that you guys decided to come on, man. I'm pretty sure we're going to be able to add a lot of value to my listeners. So, obviously that was a real quick little jump into it, but let's talk a little bit more about why you guys decided to get into real estate investing.
Yeah, go ahead, Nelson. Since you have the 30 plus years of experience and with your business and
right.
You've been doing real estate investing for a long time, so
I'll
let you do the honors and go first.
Yeah. Thank you. I've been doing real estate for a couple of days right now. So, I started doing single family, 2-family, 3-family, mixed use properties. I still own them.
Yeah.
And only recently started getting into multifamily. Believe it or not, just since March of 2019.
Oh, wow.
So I ended up joining a group that really propelled me, Brad Sumrock.
Yeah.
And been with the group since March. That was actually the first event that I went to. Learned about all the benefits. Always wondered how the hell I was going to buy a 300-unit complex.
Yep.
Like probably most people wonder.
Right.
How do you do that? So I learned the process, and since then, it's basically springboarded me into meeting a great team and being in the position that I'm in right now.
Right. And that's an awesome story to start, 8-9 months ago and already be part of 1,000 units. That's incredible, man. It really is.
Oh my gosh, I'm so blessed. I count my blessings every day.
Absolutely. What about you, Juan?
Yeah. As you mentioned, I got my start in multifamily in 2016. Although, in real estate in general, I've been around, real estate pretty much, all my life, through my dad. He's always had rental properties. He has rental properties today. And, he's always been around them. And so even as a kid, he would always say, hey, whenever you get older, make sure you buy some rental houses, buy some real estate.
Right.
But I didn't like the way, the thought of buying real estate at that time. I was younger, so obviously I didn't know, but and the reason why I say that is because he was the guy that did everything. He was the guy that found the deals. He was the guy that rehabbed the deals. He was the guy that pretty much leased the units or the houses to people.
Right.
He was the maintenance guy. He was doing everything,
Yep.
And so, as the years passed on, whenever I started looking into real estate again, because I wanted to look into, creating passive income,
Yep.
I started to notice that, hey, you know what? Real estate is the path to do this, and it is the path to go and have some passive income. But my dad was right; he was just not doing it the correct way. He was supposed to be scaling up and hiring people to do some of those tasks. And so that's when I started looking into real estate again. And so I started off with some single family homes. I realized that single family wasn't the way to go for me because it's not scalable. And then in 2016, that's when I acquired my first property, which was a 32-unit. And as you mentioned, since then, been involved in several different transactions, several different deals. And I also, can say I count my blessings, as well.
Right.
Very fortunate and grateful. Yeah.
Awesome, man. That's some interesting stories about how you got in it, and especially your dad just kind of doing everything himself. I guess that when you're looking at it that way, it could be feeling a little overwhelming, but you decided to overcome that, and you got into it nevertheless, and it's look like it's working out well for you.
Yeah, it just there's some things that you learn, business wise,
Yeah.
that hey, you can't do it all yourself, right?
Right.
And especially if you want to keep growing, then you have
Yeah.
to make sure that you leverage other people, right? Other people to help you out.
Absolutely. Absolutely. So let's talk about why you guys decided to go with multifamily instead of like, mobile home parks or self-storage, because there's a lot of different ways you can, invest in commercial real estate, but you guys decided to go with multifamily. So what was the, biggest determining factor for you?
Yeah, Ron.
So yeah, I guess for me, I would say that is going back to the basics. And the basics for me were, hey, I was in single family and I was vacant on one of my houses, and I was vacant for over a month. And guess what happens whenever you're vacant? You're paying for all the expenses. You're paying for the taxes. You're paying for the mortgage. You're paying for utilities, pretty much everything, right? Not to mention any maintenance issues that arise. So that in myself, that moment was, hey man, this sucks, man. Like this
Right.
sucks, So yes, real estate investing is good. I think single family investing is good, but multifamily is just it's just better. It's way better, right?
Right.
Because of the simple fact that if you're vacant on a house, you're 100% vacant. If you're vacant on a team unit, then you're 90% occupied still, right?
Right.
And so just that thought alone makes it, to me, much more safe. Being in multifamily. Although you're looking at a bunch more zeros, it's still much more safe in my eyes.
Right.
And you treat it as a business. So yeah, those couple reasons, or as I said, they're basic reasons, but they're true reasons. So
Right.
I still get those. Yeah.
Absolutely.
Yeah, so for me, I mean, I think the big draw was to go bigger, faster. And, I still own single family, multifamily, mixed use, commercial. And the good thing is, because of my business, I allowed my managers to handle a lot of the problems that most, I guess, owners would have to take upon themselves to take care of. My relationships with my GCs and my contractors, I've, had for a long time, 30 plus years. So, I'm very fortunate in that manner. But, my thing was, in my company, my landscape company, I service HOAs, homeowners associations, and I, service commercial buildings and things like that. And to me, it was intriguing with the process of, how do I get myself in that situation with multifamily? And after finding out about what I found out in March, and being a part of a group, and learning the underwriting and understanding the process of how to do it, just made a lot of sense for me to want to get involved and to, work with the team and develop the relationships that you need to put myself in the position that I'm in right now.
Right.
And the fact that you could offer, a living place for people, not only is it benefiting you, but you're benefiting the people that you have in your units by giving them a home, an affordable place to live, and a community. So, I mean, to me, that's what it's about as well. Like, I'm not doing that with a shopping mall. I'm not doing that with an office building. Multifamily is the way I can give back to the community.
Yeah, and that's awesome. That's awesome. So let's talk about you guys are invested in Houston, Texas, right? Where else are you investing?
Yeah, so Houston, and I would say Houston because it's a strong market.
Yeah.
We like to see the supply and demand factor. Supply and demand is one of the basics. Going back to that.
Yeah.
There's a big demand and limited supply of B and C workforce housing.
Yeah.
We like Houston. We like Dallas. We like Phoenix. Atlanta's another market that we like.
Right.
So those four markets, but more specifically, which ones we're currently in. That's Dallas, Houston, and Phoenix. So we try to focus on those markets because those are all three strong primary markets.
Yeah. So when you're looking at these markets, and just so my listeners can understand, How do you find a deal? Like, what do you do to find your deals?
Yeah. So, I think the overwhelming majority of the deals are going to come through brokers, right? These are the guys that have those relationships with those sellers, with those owners, and they're the ones that control the deals, right? So they have those relationships because they've transacted with the same owners, several different times. So it's not uncommon to see a broker that will claim that, hey, that property over there, that's my property, and it not literally saying that that's their property, right? They're not like, and title is not under their name. The reason why they say
Yeah.
that is because they've sold it to A owner, B owner, C owner, D owner, and then whenever D owner is ready to sell, he's going to sell it to E owner as well, right?
Yeah.
So these guys have those long relationships with these owners. They have long relationships and understand these properties. I would say that's the overwhelming majority. Now, having said that, my first property, which was a 32 unit, that was the deal that I found off market. That was through direct mail.
Yeah.
So that was a little bit of a different strategy. So I
Right.
would say, yes, it does work.
Right.
It's not as easy as you would think, but it does work, and so
Yeah.
I'm living proof of that.
Right.
So,
Now let's touch on that for a moment, because there's going to be people that's listening to this podcast that are seasoned like yourself, that's out there crushing it, and they got to go direct to a broker to find those big deals, and then there's going to be people that are just getting in it like yourself a couple years ago. That's like, man, I want to get in, and sometimes those brokers are not going to take them seriously because they haven't done anything. So how did you find a list, or what did you do to find, that owner that was willing to sell to you?
yeah, that's a very good question. And I think just to backtrack a little bit, I think everybody has to understand what the position that they're in.
Yeah.
If you don't have that track record, then okay, well then maybe partner with people that do, right? Then you
Right.
can get into that way. Or if you're looking to take down deals yourself, then again, you don't have those relationships with the brokers. Still reach out to them. Try to build those relationships no matter what.
Yeah.
But specifically talking about doing the direct mail marketing, the way I did it was I looked at I looked at Houston area because I'm here local. I looked at the
Right.
Houston area, and Houston's massive, right? So
Yeah.
it has a bunch of different zip codes. So I specifically looked at different zip codes that I wanted to target, and specifically 30 minutes, no more than 30, 35 minutes away from where I live.
Yeah.
And so, I made a note of those zip codes. Then, my next step was to find, properties that had been owned over 3 years. And I found these on the county assessor's website.
Yeah.
Why over 3 years? You may ask. There's a specific reason for that. For me, was because if it was over 3 years, then most of these owners would have already done their business plan if they
Yeah.
had a business plan going, and they would be ready to exit.
Right.
Or if it had been owning it for many years, 10, 15, 20 years, then obviously that's another reason. But if they had owned it for a year, maybe 2 years, it's they just acquired that property. Chances are they're going to be less likely to want to sell, right?
Right.
So that's the way I did it, and then I filtered it down even further by the sizes, which for me was under 50 units at that time, and so yeah, that's what I did. I sent out letters. I did do them handwritten. So because I wanted to be a little bit different than not just send a yellow letter like everybody else does.
Yeah.
So I wanted to distinguish myself and differentiate myself from everybody else and from the pack.
Right.
And that was doing the handwritten letters and send them out directly to people. And got a lot of response. I didn't make any offers. I didn't make any moves, on the first few because the prices were, to me at the time, were overpriced.
Yeah.
And then until the one that I came across, which made sense, and we proceeded to take that one down.
Yeah. So just out of curiosity, man, how many letters do you think you sent out, and what response was it? 5%, 2%? Do you remember that?
So honestly, I was not keeping track because I was just sending letters out, right? So I'm gonna have to be honest on that. So I didn't have like all the metrics to keep track of what was going on.
Yeah.
But if I had to guess, I would say it was less than 2%.
Yeah.
Maybe 2 to 4%, something like that at the most. But my response was at the beginning, which was for me, I was fortunate for that because some people don't get that response until, 2 years later or whatever, right?
Right.
For me, it was like immediate response. It was small response, but it was immediate, right? So,
right.
So that was, I guess, the difference, in my timing. Timing is everything. And when you're doing direct mail, timing is 100%,
Absolutely.
the timing and consistency, those two things,
Right. Yeah, that's cool, man. What about you, Nelson, man? Do you, how do you recommend somebody going into a market, something that maybe Juan, didn't mention? Like, what do you kind of look at, or what's your strategy?
Well, I kind of do the same thing that Juan does. I mean, really, it's about relationship building, man. It's like anything.
Yeah.
You want to build relationships with the brokers that are the movers and the shakers in that industry.
Yeah.
I've been looking down in Florida right now. That's, my focus is Florida to be able to bring to the team.
Yeah.
And, Orlando, Tampa, Jacksonville area. I touched a little bit in Georgia.
Yeah.
So the only way that I even can imagine getting in is having direct relationships with the brokers. And that's what I've done. Picked up the phone, have gone down to visit them. So people don't think that you're just blowing smoke, that you're kicking tires.
Right.
If you don't show enough interest to go down there and see the people that you're talking to on the phone, they think you're kicking tires and they're never going to give you any opportunities.
Right. Now, share with the listeners, if you would, man, how do you identify the brokers you want to work with?
I think the brokers that I look for are brokers that have already been doing multifamily specifically. And how I identify them is usually through connections that I have in New Jersey, believe it or not.
Yeah.
National brokers that they know I have a relationship up here with them, and I'm constantly looking at deals in New Jersey. I buy deals in New Jersey still. I look at deals up in Maine because I have an interest up there because I own properties up there. So depending on what I'm trying to do or what market I'm looking for, I'll reach out to my broker, who in turn connect me with the brokers in those offices. And because I have a relationship with the people in New Jersey, they know I'm not kicking tires. Like I make things happen.
Yeah.
So when I connect with them down there, they already have things on their radar of what they'd like for me to say. So they'll send me the deals and I'll literally fly down, meet with them, look at the properties, walk the properties, feel out what the area is like and do a tour. I mean, and that's really what it's about. It's about connecting with the people that you want to do business with and making sure that, you're not a tire kicker, that you're serious and that you have other deals under your belt that can, and they know that you can make it happen.
Yeah.
And that's what I've learned from the team that, surrounds me and that pushes me and says, hey, you can do it. Look, we're doing it. You're doing it now. You're going to do it again. It's just a matter of establishing those relationships and getting to know the right people.
Absolutely. That's great, man. The fact that you will get on the flight and fly down and go meet somebody, that's going to let them know you're serious. You're not just pulling their legs saying, hey, send me deals. So that's awesome, man. All right. So, tell me, man, Juan, you just got started, about 3-4 years ago. If you can remember back, man, what was the biggest challenge you faced? Obviously, finding deals, but other than that, like what was some challenges you faced when you were first getting going?
Yeah. So I would say understanding, markets, understanding markets and understanding what a good deal was versus a deal that wasn't a good deal. Because, I think, everybody wants a good deal. Everybody wants a deal that has strong returns, good numbers and all that good stuff, right? But how do you know when it is a good deal? And how do you know if it's not, too aggressive or whatnot? So I think at the very beginning for me was more on the underwriting side, in comparison to the market, right? Market cap was this, am I paying, what cap rate am I paying, based on the price that it's at? How do I account for the proper repairs? How do I account for, proper, taxes, those kind of things, right? It just a lot of the little underwriting things. Yeah, I think what was a little bit more of a challenging at the very beginning. but also, the other side of it is building relationships with people, right? So like that, you have those potential partners or potential investors, or just building your network. So that's the challenge at the very beginning if you don't have a track record, right?
Yeah.
But luckily for me, I would say is I didn't know what syndication was. I didn't know about that really. Whenever I first acquired my first property, I acquired the property and then I started learning more about that. I was like, oh wait, there's another way. Let me look into this and see what's out there. And so I think just because I had some experience that helped me. That helped my process. When dealing with the larger properties, it made it a little bit easier. So yeah, I would say those couple of things. You just the underwriting, understanding with the markets, and building your network.
Right. Now, touch on that for a moment, man. Somebody that's listening, like, man, that sounds like a great idea. But how do you, approach someone to ask them to join your team, or what's the best way to approach someone to get involved with them? Like, what are some tips you can give there?
Yeah. So, I definitely would say do not reach out to somebody and say, hey, man, let's work together. Somebody that you just don't know, right? I don't think that's the right approach. I think really the best way is to build it organically. And then, let's say I wanted to work with you, I wanted to work with you, Willie, right? So
yeah,
let's say I wanted to work with you and you have some strong experience. I'm not there yet, right? I want to learn, and I'm eager, and I'm willing to put everything on the line to get to that position.
Right.
But at that point, I have to figure out what I can offer you, right? And have to be realistic and be honest with myself on what I can offer. If I have a strong balance sheet, then hey, maybe I can offer that, right? If I have strong relationships with brokers and I have a good deal flow, then maybe I can offer that. If I have a strong network, then I can offer that. Just whatever you can offer, you offer it, right?
Right.
And that's how you're able to build those relationships, because everybody's going to want to be involved in a deal somehow. But like I said, you have to figure out how you can stand apart, from the crowd, and what value you can bring, because everybody can bring something. Everybody has something valuable they can bring. There's nobody out there that does not have anything of value. Just find out what it is and make that your strong piece to the puzzle.
Right. And that's some good points there. Nelson, is there anything you want to try to add to that?
No, I mean, I think that's how I was able to really connect with the team. You know what? And I think a lot of it is just being genuine. Just be,
right.
I mean, that's really important. People like to put facades on and think that they're more than they really are. But, as Juan mentioned, just, think about, like, it's really a lot of soul searching too. Like, what can you offer that person? It may not be the experience of multifamily. I don't have the experience that I feel I need to be able to take down my own deal as one.
Right.
I just don't. I mean, if I wasn't surrounded by people like Juan and like other partners that I'm involved with, I wouldn't be in the position I'm in. But, I think the main thing is, be honest with yourself and what you feel you can offer those people, and just be, truly genuine and give 110%. No matter what you do.
Right.
Give 110% and be eager. I mean, there's nothing wrong with being eager, but focus your energy on being eager, not in an annoying way, in a way that's gonna help the team and help you grow.
Right. Absolutely, man. So let's talk about the kind of deals you're looking for right now, as far as unit count, class, and what's the reasons behind it.
Yeah, so I guess I can start this one. So yeah, deals that we're looking for are B and C workforce housing type of deals in primary markets. We always like to see some value added potential into the deal. We're okay with doing like a hybrid, whereas a mix of a yield and a value add. That's fine, because that's that's the kind of deal that we have now that's in Houston.
Well, hold on. Let me pause you there for a second, because somebody might not understand that. What do you mean when you say yield and value add?
Sure. So whenever I say that, basically a value add can, so there's different levels of value add, there's the value add where you can, there's units that are below market rents. That could be a form of value add just by increasing the rents, right? Or
Yeah.
maybe they need some renovations, right? Some light
Right.
renovations, maybe 2, 3, 4 grand, whatever.
Yeah.
That's another form of value add, right? Operationally, there could be a value add. Now there's a deep value add where that's more of a deal that's not stabilized. And let me explain stabilized. Stabilized usually is like 90% or higher on
Yeah.
occupancy. That's what the lenders want to see. We usually the Freddie Mac and Fannie Mae
Yeah.
agencies they want to see. So if it's not stabilized, then it's a deep value add. And a deep value add, could be where you're putting 20,000 a unit into it, or you just have to increase the occupancy and get it up higher, right? So there's
Right.
different levels there. A yield is more of a property that you're not really doing too much of a value add. It's more of just a return. You're looking at just
Yeah.
returns. The property is already strong. It's already performing. You're buying it, and you're looking at the returns. So you're looking at just the returns specifically more than anything else. So the property that we have now is already a property that's performing. It's already a property that's stabilized. It's already a property that has had a lot of capex, into it, invested into it.
Yeah.
But it does have some value add component to it, to where, hey, we can still do 60% of units, in this property, specific property.
Yeah.
So that's what we call it a yield. I mean, a hybrid, right? Because it's got a little bit of combination of both. So that's what I would say on that. And then as far as the type of properties or unit count specifically, we're looking for deals that are like 150 units and higher. Again, in primary markets. And so we like primary markets because, although we can look at secondary, tertiary markets, the primary markets for us make more sense because yes, there could be more competition, on the front end when you're buying a property, but we always look at the back end as well. If there's if it's a primary market, there's going to be a buyer, as well on the back end, right? It may not be the price that you want at that specific time, depending on the market, but there's going to be a buyer or two interested. Now, if it's a tertiary market in the middle of nowhere where nobody knows, sure, you can buy at better pricing, but it's not a national market. It's not a global market like a Houston DFW or something like that. Then it's going to be much tougher to exit as well.
Right. And that's a good point there. Now, when you're looking at your deals, I mean, obviously, you guys got to be looking at deals every week to try to find an opportunity in this hot market. What are the red flags you guys kind of look for when you're doing your underwriting?
Yeah. So I would say, I mean, there's a few different red flags that we look at. So, we look at for deals that have, that first of all, I guess I can start from the very beginning. The very beginning for us is looking in a state that's, landlord friendly, right?
Right.
Not tenant friendly, landlord friendly. And I'm sure you've heard this many times before, but I'm not going to buy a deal in California, New York, even though I love those states. People there are great. It's beautiful, but they're just not meant to be deals that are ideal for multifamily investing, or even single family investing for that matter, because they're more catered towards, their laws are more catered towards the tenants, right? Whereas like a Texas, in Arizona, Atlanta, Florida, they have more of the landlord friendly laws, so they're catered more towards the landlords. And so also look for states that have they're business friendly, right? So because what does that do? What does that do? If it's business friendly, it creates job growth, right?
Right.
And if you have job growth, then that creates population growth. And if you have population growth, that creates a demand, right? And if you have a demand, then that creates limited supply, and then you have also better rent growth, lower occupancy, those type of factors. So we look for those, because that's really the formula that we look for. But that's definitely something that we look for is, as far as the in-migration. We've got to make sure that we have the immigration and the population growth. Also crime rates. You always want to look at crime rates. Income level and those kind of things. But yeah, those are some of the items that we look for.
Yeah. Now, Nelson, if you could, man, would you just kind of give us an example of something on the financial side that when you're underwriting, you say, something about this doesn't look right. Like, what's some things that kind of jump off the page to you when you're doing your underwriting?
Well, when the occupancy is not too great and you're not able to fill the units, and you look at, the T12 and it's like, well, what's going on here? So to me, I mean, you really want to make sure the occupancy rate is up and being able to cover the nut,
Yeah.
right? I mean, that's like a major flag for me. And like,
Right.
why
Right.
why is that situation the way it is?
Yeah.
So, and it all involves like what Juan's talking about, whether or not it's going to be a good area,
Right.
all about the growth.
Right. Absolutely, man.
That's really important.
Yeah. That's a really good point there. Really good point. Now, there's a lot of guys that are wanting to get into the syndication space, and, they're doing it, but there's a lot of mistakes being made. So, what are some of the biggest rookie mistakes you guys seeing being made right now?
Yeah, so I have seen a different underwriting from different people, different groups.
Yeah.
And some of the underwriting, were just not realistic. For example, and I won't ever say any names, but like, for example, I saw a deal in a tertiary market in Texas not too long ago.
Yeah.
And it was sent to me, by another good friend, right? He sent it over, and then he asked me for my opinion. And so I just kind of looked at it as if I was the one looking to invest in that deal.
Right.
And so one of the things that I saw was, first of all, it's a tertiary market, right?
Yeah.
It was a tertiary market, which, personally, I'm okay with that. I actually have a deal. I'm a key principal. I have some equity position in a smaller deal in a tertiary market. So I won't say that I will never go into a tertiary market, but it's not my first focus, right? So first of all, it was a tertiary market, and then the loan that they were getting was a bridge loan. So a bridge loan already adds more risk to a deal, right?
Yeah.
So it's already something, and I would say that the guys taking it down were newer, yes, but it's a bridge loan in a tertiary market, right? And so the problem with the bridge loans is that you have to be able to do something within the required time frame, and that time frame could be 3 years,
Yeah.
it could be 5 years, just depending on how what the terms are, right? So
Right.
you have to be able to refi, you have to be able to sell, you have to be able to do something, and so yeah, you can have your projections, but the market always determines what happens, right?
Right.
So there's that. The other thing that I noticed on that deal was that it had a 2% rent growth, right? So a 2% rent growth is not unrealistic in like a primary market, but this is a tertiary market that we're talking about here. So
Yeah.
if we are looking to put in $5,000, $6,000, whatever into a unit into it, you can't expect to get that same rent pop that you will get like in a DFW, in a Phoenix,
Right.
in the Houston. You just cannot, right?
Yeah.
Because it doesn't have that same job diversity or that same demand that these other primary markets have. So just in contrast, we do 2% for our Dallas deals, for our Houston deals, and for our Phoenix deals. Why would I do a 2% in a tertiary market where there's like 100,000 people, right?
Right.
It just doesn't make any sense for me, right? So there's that. The other thing that I saw was the reversion cap. The reversion cap for me, when I saw it, it was.
Well, hold up. Let's stop there, man. Explain the reversion cap, because I know somebody like, what the heck is that? So go ahead and explain that.
Yeah, so maybe I'm going too fast on this, but so a reversion cap is basically what you think the property is going to sell, right? Is an educated I want to say, I guess, is an educated number that you believe where the property will sell and where the market is going to be, right? Because
Right.
Cap rates are market driven. So even a reversion cap is if you're buying it, for example, if I buy a property at a 6.5 cap, that means that for all intent of making it simple, simplicity reasons, that means that if I pay all cash without making any changes to the property, without making any improvements to the property, I expect to get a 6.5% return on my money.
Right.
So if it's $1 million property and I get it is a 6.5 cap rate, then that's what, 65,000, right? So that's what I'm expecting to get, right? So now when you go to sell the property, you also have to have a reversion cap like that, because it triggers or sways the returns so drastically.
Yeah.
So you have to be able to determine what the cap rate is going to be at that time. If you're holding it for 5 years, what is the cap rate going to be at that time? And again, you have to find out this information by looking at the historicals, right? Look at the historicals, look at how the market has gone. and then you can make that determination. So if the cap rate that you say, like for example, in the case that on this deal, they had a 7.5 cap, right? And this is a tertiary market. We're doing 7.4, 7.5 in deals in Dallas for reversion cap. So we're assuming that the market is going to get worse. But this is Dallas, which is a superior market to a tertiary market like this one was.
Yeah.
So how are you going to say that this is going to be a 7.5 cap, the same as it will be in Dallas, or even the 7 in Dallas is still so much better, right? And so that was another red flag for me. And so, among other things, right? But so those are some points that I gave to my buddy. And I just said, hey, look, here are some things that you got to look at, and I'll let him make his own decision. And he's like, okay, well, thanks, man. I'm not going to proceed. You really opened my eyes here. So not to knock on the deal or anything, but you have to really be realistic on some of these numbers and some of these assumptions that you're doing, right? And some of the people out there, are being unrealistic with some of these numbers.
Yeah, man, that's well said. Very, very good point. It's marketplace. You got to look at the city that it's in. Is it a primary, secondary, tertiary market? Rent growth. What kind of bumps are they expecting? And like you said, all of this information is stuff that they can get a pretty good estimate on, just kind of looking at the 10-year history of how that market has performed. And in the reversion caps, a lot of people to try to make the numbers work, because you can make the numbers work if you want to, but it's very dangerous for your investors. And that's one thing that I kind of look at, man. If I'm going to be, investing somebody else's money, I'm going to be way, way more safe with that money than I would with my own money. I'll take gambles and risks with my own money, but when you're talking about somebody else's money is at stake, you need to be very, very conservative. So, man, you made some really, really, really good points there. Really did. All right, man. So, let's segue into the next segment of the show, man. The deal deep dive. Let's talk about a deal that you've done recently, and let's kind of look at what it was that you guys liked about it.
Go ahead, Nelson.
I'll let Juan do that.
Okay, so a deal that we took down recently. I guess the latest deal was our Phoenix deal. So what specifically would you like to know about that one? Okay,
so how many units was it? Was it a value add, and the kind of debt, and what's the exit strategy for it?
Yeah. So this was a deal in Phoenix, Arizona, a 236 unit deal. Yes, it's a value add deal for sure. So value add meaning on this deal, we have some renovations to do, and also some repositioning as far as like re-tenanting the property, right? Not the entire property, but there's a good mix of tenants there, and we want to definitely improve on that tenant profile. So yeah, it's a deal that we took down in August, right? Nelson, it was in August. And so it's been 3-4 months that we've been into this deal now, and we're going through the middle of the repositioning right now, and so a lot of big changes going on. As far as the debt, we have a Freddie Mac 10-year term on this, so we were able to achieve 80% leverage, and also able to achieve 5 years of IO, 3.7, 5 years of interest only. And then 3.7% rate. So IO, for the audience, in case they don't know, is just interest-only payments that you're making to the lender. And so maybe you ask, why would you want to do that? Why not pay the principal? It doesn't make any sense. Whenever I buy a house, I'm paying the principal like from day one. Why would you want to do the same thing for a commercial property? Well, if you have IO, it helps with the cash flow, right? So you're able to get stronger cash flow because you're paying less towards the loan, and you're only paying them interest, right? So you're able to have higher cash flow, and so that's what we want. In this business, we're investing specifically because we want to make a return, and one of those best ways is through the cash flow, right? On the back end, that's all great and dandy, but we can't determine what the market's going to do in 5 years. It's the market, is gonna call the shots, and we don't really have a say in that. So So that's why we want the cash flow. That's why we do IO.
Yeah. Now, let's dig a little bit into the value add component. So you guys are going to reposition it. So is that going to be new signage, painting the outside? Like, what are you guys doing there?
Yeah, yes, for sure. So we are not necessarily replacing the sign, but we are improving and improving it and doing some lighting for the signage.
Yeah.
Definitely exterior. I had already been painted, so it wasn't necessarily needed on this property. But we are doing some exterior improvements
Yeah.
and landscaping and those kind of things. And just inches way, driving into the property, you want to make sure that that's one of the first attractive things. So you want to make sure that that's one of the first things you do to a property
Right.
to improve it, because you want people to get to your leasing office, right?
Absolutely.
If they're like on the main road and they don't get to your leasing office, you got to find a way to get to the leasing office. Once they're in your leasing office, then you got to wait. You got to find a way to make sure that you close on them, right? On the ones that are tenants that can qualify, right? You got to make sure that you close on them, and that's when you're able to show them your leasing office,
Yeah.
the professionalism of the staff,
Yeah.
maybe unit interiors and all those good things. So
Right.
yeah, that's what we do.
Yeah, man. And one good thing I just want to mention here that people probably don't think about is, when you're buying real estate or multifamily real estate, you're not only buying the land and the building, but you're buying a business. And what he's talking about, this value add, it's all about perception. You want people to come in and have that wow factor, and that's how you get the best tenants. And I imagine that's what you guys are achieving with your strategy over there, right?
Yeah, for sure. Once we do those kind of renovations, because everybody wants something nice, right? Everyone
Right.
wants something nice at a good price. I mean,
Right.
that's just the nature of humans, right?
Absolutely.
The best for the less, right?
Right.
And so, or the least, I should say. And so, in this case, we're definitely improving the property. It's still going to be affordable for the tenants, and they're still going to be able to, get them at good rates, and that's what we're doing. And we're excited because we're entering the peak leasing season, so we're going to take advantage of that.
Yeah.
It's really going to turn the property around.
Gotcha.
So one neglected to speak about is the fact that we are renovating the leasing office and adding different community centers in that office where, we have an office, it's like a business center. We're going to be adding some outdoor spaces that allow people to congregate and enjoy the community. So, I mean, and that to us is really important, is forming that sense of community. So when you do get the right tenant in there, like, they don't want to leave, and you're creating a sense of family,
Right.
and other family members want to rent the place. You want a situation where you're actually taking names and putting them on a list, a waiting list.
Yeah.
And in order to do that, you need to form that sense of community. And by creating certain programs for kids, giving them spaces to congregate in,
Yeah.
recreationally. There's 2 pools on this particular community that we have in Arizona. And, if you can offer them security and community and a sense of belonging, you won't need to look for tenants. Tenants will look for you.
Right. And that's some very good points. And one thing I want to ask you guys that people don't think about as well, how do you determine how much to go into your value add? Like should I put 5,000 a unit or 10,000 a unit? Like, how do you come up with that valuation?
Yeah, that's a very good question, and I think it really is depending on the market, right? Depending on the condition of the property, right? That always has a lot to do with it, right? If it's a property that's falling apart, then you're going to need a lot more than $5,000, right? It's just going to be the nature of it, right?
Right.
So it's a combination of exterior and interior units, and so but it's also a combination of not only knowing that, but also knowing what the competition is doing. What are the comps doing, right? If the comps are doing granite and they're doing the latest and greatest and have all these different amenities, and they're getting $200 in rent premium, then your property is, then you have to and if you're looking to achieve the same level, then you have to do what it takes to get to that point. And that could be 10 grand a unit. You know, it could be 15 grand a unit. Who knows? But so it's all really market driven. It's also, you know, determined by the condition of the property, the asset, right? If it's been neglected severely, then it's going to need more. It just, there's never a property or two properties are going to be exactly the same. It's just, you know, case by case, you know, deal by deal.
Right. Now, when you guys are kind of looking at your budget and finding out what your CapEx is going to be, you know, going into the syndication, do you guys raise all the money for the CapEx, or do you kind of go with a bridge loan to kind of alleviate some of that pressure?
Yeah. So we raised the money. We raised the capital for those, you know, the CapEx items.
Yeah.
And so you can either do it through a Fannie Mae or Freddie Mac loan. And Fannie, they usually have to have, you know, they will hold it in their escrow for, you know, for draws. You have to, you know, get draws.
Yeah.
And whereas Freddie, you can have it separately. So you get the loan and, you know, you kind of manage your own CapEx budget, in your own account, you know, it's no big deal.
Yeah.
And so, but yeah, we always have to raise it. And I learned that, you know, since my first deal, because my first deal, I didn't raise any CapEx. And so a lot of the CapEx that we did was coming out from cash flow. And so it was a big mistake that I did, a big learning mistake, you know, a big mistake where I learned from, for sure.
Right.
But yeah, make sure that you don't, you know, you make sure that you raise your CapEx budget up front, and you don't take it from cash flow, because then you're gonna be hurting. You're gonna be hurting for a while. I mean, it's a big pop at the end, but in the meanwhile, you're like, man, what the heck? This is too much work for nothing, you know?
Absolutely, man.
So yeah, we always raise it separately, for sure.
Yeah, and that can go into the rookie mistakes there, to go into a deal with not enough capital raised for the expenditure. So that's a really good point there, man.
For sure, make sure that you raise enough, and you know, if you think it's going to need $1 million, make sure you raise a little bit more, because you know, there's always going to be surprises. Every deal there's surprises and things that you didn't expect, or you're like, it's going to cost this much because I've been at the property. But well, guess what? Something's going to break. That you don't expect to break, you know. So just make sure that you're a little bit over on that to be safe, right?
Absolutely. And I'm guessing your strategy is value add, so you're going to always sell at the end of 5-7 years whenever you achieve your set goals. As far as
yes. So there's reasons for that. You know, I would say that so there's definitely reasons for that. One of the reasons is because, you know, our investors want their capital back, right? So if they invest with us, they're going to want their capital back, you know, in 5 to 7 years, right? They don't want to leave it in the deal for 20 years, right?
Yeah.
So that's one reason. Another reason is because, you know, the lenders, you know, they have, you know, we're only doing, you know, 10-year terms or 5-year terms or 7-year terms or whatever it is that we're getting ourselves into. So they have this, you know, quote unquote balloon, right? So you have to make sure that you're able to either exit by refi or by a sale. So you got to be able to do something anyway, right? So, and then the third reason is because, well, there's actually 4 reasons. The third reason is because you're able to, you're able to have the velocity of capital, right? So if I give you 100 grand and then you turn it into 200 grand within 3 years, I can reinvest 200 grand now, and then those, you know, get doubled in 3 years. Then now all of a sudden I have, you know, way more, right? So there's that velocity of capital where you keep it going. That's you're able to build wealth. But the fourth reason is because, you know, every 5-7 years you got to do more renovations, right? 5-7 years, you know, I did renovations 5 years ago. Guess what? Now they're needed to get, you know, updated again. You know, so there's a lot of reasons for that. So yes, we hold them for 5 to 7 years, typically 5 years. But yeah, you know, maybe moving forward, you know, it can change to do a little bit longer, you know, term holds, you know, but for the time being, you know, while we're syndicating, for sure, yes, it's going to be like this. Yeah.
Good points, man. All right, so let's segue into the last segment of the show. It's the lightning round. I'm going to ask you 5 questions, and we're going to just spit them out. All right?
Okay.
Yeah. All right, so what's the best advice you guys ever been given?
Ooh. I don't know. Oh man, for me, it's just, you know, once again, be genuine and you know, work hard, play hard. You know, I mean, just do the best you can with what you got, and just, make sure that you're true to yourself, and give it all. Never underestimate what your true potential is and can be.
Right.
And then don't let anybody influence what you're capable of doing.
Absolutely.
Yeah. So for me, it's somewhere along those same lines. I would echo, pretty much everything that Nelson said. And I would just add that if you want something, find out ways to do it, and do your best to get it done. We can all make excuses for everything. This doesn't happen or this is not fair. Guess what? Life is not fair. It's not meant to be fair. It's not going to be fair. But if you want to put yourself in a better situation, then you have to work hard for what you want and go out there and get it. And put yourselves in those situations and those people, the people in the network, like that. You have those better opportunities and those better options to put yourself in those better situations.
Yeah.
So yeah, that's kind of what I would say.
Got you. All right. So, we're in the new year now. So what's the best book you've got read, I guess, in the last year or so?
So I'm not much of a book reader, but I like.
Okay. Wait,
I
do
like
you do audio books?
I do audio books, and
That works.
honestly, I can't even remember the last one I listened to. But it was about running. So
Yeah.
I mean, the only thing I could do is relate running to life.
Right.
What you put in is what you get out. I
Right.
mean, if you're not willing to put the time in and the effort into working hard and training and achieving a goal, I think the same holds true with multifamily. If you think that a deal is going to come to you, it never will. If you're out there doing all the things you need to do to make that deal happen, it'll happen.
Yeah.
And and that's how, I mean, sports are very relatable to real life. I mean, it's all about the training and how much you put in is
Right.
kind of what you reap at the end. So
Right.
you do little, you'll get little. If you do a lot, you'll reap those rewards. And to me, that's really important. So as far as educational books for business or anything like that, haven't read one in a while. But the running book, I can definitely relate that to business and just all of life in general.
Gotcha. What about you, Juan?
For me, in the last year, I've read so many books. Not as many as I had hoped for, but I did read quite a few books. But for sure, I would say it was "Can't Hurt Me" by David Goggins. That was just an outstanding book. It was on Audible, and I would highly recommend that one. So
Yeah.
yeah, David Goggins, "Can't Hurt Me."
Got you. What are some rituals you guys are doing right now to help you be successful?
Just once again, just work hard, man. People always ask, like, how do you do so many things in a day? And it's just focus. Just staying focused on what you need to do for the day. Come up with a schedule. Just make sure that whatever your time that you invest, it's going to be productive time. I mean,
Right.
I think if I watch an hour of TV a month, that's a lot. I mean, I know football season is really important to most people. To
Yeah.
me, if you told me who's whatever 15-0, I have no idea.
Yeah.
Like, it's just not my interest. So
Yeah.
to me, if I can help progress my income, it's going to help my family. And really, that's what I like to do. I like to stay laser focused between my business of multifamily, my core business, which is my landscape company, snowplow company, and also my personal real estate endeavors. And
Yeah.
that's what's going to help me in the long run. And other
Right.
people, other people. If I can share the information that I've learned, even though it's such a short amount of time, to help them, that's all I'm about.
Right. What about you, man?
Yeah. So for me, I would say, a lot of the same that Nelson said. Just for me, is has been a lot of focusing on relationships with people. I think that definitely has helped me to be more successful, because you're never gonna know it all, and there's always going to be somebody that's smarter than you, that's better than you, and whatever. I mean, it's always going to be somebody out there that's that can help you out, right? And so you have to make sure that you're humble enough to be able to ask for help, and don't leave your ego at the door, as you've heard that quote many times.
Yeah.
And just build on those relationships. That's really where things come together.
Right. So, I mean, what is one thing you guys are focusing on in 2020 to help you improve your business?
For me, I would have to say my underwriting skills. I fall a little short on how I underwrite, only because I may not be extremely familiar with the marketplace. But I call on people that are, and I think that as Juan mentioned, like relationships, knowing who you can call on if you're not familiar with an area or a submarket, or even contractors, to when you do get to the point where you're looking at particular site or a deal that you may not be familiar with, who's around you. So it all kind of revolves around relationships.
Yeah.
So I would say for 2020, I would like to look at scaling. And so, part of that scale is going to be, like, as Nelson said, is on the underwriting is make sure to look at a bunch of deals. And, as we're looking at a bunch of deals, and also, keep better systems like that. You're able to keep track of, the deals, the relationships, and, just focus on that. So 2020 for me is a year of growth. It's a year of a lot of hard work. It's a year of, we're going to be increasing my relationships with people. And, just, got the foot on the gas pedal. So hopefully that's the way it is.
Got you. All right, man. Last question for you guys is my favorite one. If you can give your younger self one tip in regards to investing, what would that be?
Ooh, that's a tough one. Juan, I'm going to let you go first on that. I've been living a little bit longer than you, Juan.
So he's got to go back a little bit further.
I got to dig deep, man, for this.
So yeah, I think for me, I would say, if I could give myself advice, just 10 years back, right? I would say to focus, again, and I said this, a couple of times, focus on relationships, because relationships is what gets you to that next level. I seriously believe that, because you can't do this alone. And if you think you're going to do it alone, yes, you can do it alone for a little bit.
Yeah.
But I mean, there's this quote, and I forgot who says it, but if you want to go fast, go alone. If you want to go far, go together, right? And so you got to make sure that you focus on relationships, but also I wouldn't be afraid, right? Because I think the other thing is that stops a lot of people is that fear of, oh, what if this doesn't happen? What if I lose my money? Yes, that can happen for sure. That can happen, but you also you're taking a lot of risk by not doing anything, and that's really the bigger risk. If you're sitting on the sidelines hoping and praying that something comes to you, it's not going to happen. You're going to sit there 20 years later, and you're still going to be hoping and praying that something comes to you.
Right.
So make sure that you're able to take action, take those risks. And don't be afraid. If you have a strong person on your side that tell you that this is a green light, then take his advice and go for it. So right. That's what I would tell my younger self: build relationships. Don't be afraid to take those risks.
Yeah.
Boy, that's always a question that is kind of loaded, because I think my younger self would probably smack me in the face if I said this. But to me, I think that all the lessons that I've learned growing and achieving have put me in a situation where if things didn't happen the way they did growing up, I probably wouldn't be in the situation I'm in. So I think just living the way I did and learning by the school of hard knocks, matured me to this day. So advice would be, you know what, I wouldn't tell my younger self anything, because it really created who I am right now.
Yeah.
Maybe if I was to tweak it a little bit, as Juan mentioned, maybe I would have started forming relationships a little bit differently
Right.
when I was younger, instead of being a little bit more sheltered
Yeah.
and not being as open as I am right now. I would offer that suggestion. Like maybe I should have been a little bit more open and honest, maybe with myself, not so much with other people. I mean, I've always been honest with other people and forthright, but I think the younger self, like you never really want to look back. My thing is always looking ahead. You
Yeah.
always want to look ahead because you can't change what happened in the past. The
Right.
past is molded you to who you are now. So to look backwards, it's really tough for me to digest 100%. So relationships are huge. Maybe I would have formed different relationships, but then if I did, would I be in the situation I'm in right now? Maybe not.
Yeah.
I don't know. I mean, we've all lived here X amount of years, and we've all have learned things that have taught us what we did in the past.
Yeah.
So to look back, I never try to do. I always try to look ahead.
Gotcha.
So
That makes a lot of sense, man. That's just always before. I mean, from what I hear you saying, is always be forward looking, man. Your past it makes you who you are, but always be looking forward to the new opportunity that's in front of you and seize it with both hands. That's what I got from you, and it makes a lot of sense, man. Some good advice. All right, man. So we're coming to the end of the show here. Nelson and Juan, man, tell my listeners how can they get in touch with you.
Good one.
Yeah. So if people want to reach out to me, then they can reach out to me through email. That's Juan@GenWealthCapital.com, Juan@GenWealthCapital.com, or they can reach out to me on social media. I'm all over social media as well. Facebook, Instagram, Twitter, LinkedIn. That is at thejuanvargas.com or at thejuanvargas, but also have a website, thejuanvargas.com. And so, yeah, they can reach out to me any one of those formats, and I'll be happy to have any conversation or I'll be happy to help out any way I can.
Yeah.
Yeah, best way to reach me is email as well. It's nlee@landscapeworks.net, nlee@landscapeworks.net, or they can reach out to me on Facebook. I'm not as technologically inclined as probably you guys are. I don't have a Twitter account. So, but definitely reach out to me on Facebook, man.
Yeah. Good deal, man. Hey, well, I appreciate you guys coming on today, and you added a lot of value to the listeners, and I'm looking forward to working with you guys in the future.
Same here. I appreciate the opportunity of being on your show, man. Thank you.
Yes, sir. You have a good one.
Yeah. Appreciate it. Thank you so much.
All right. Take care. Thank you.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.